Welcome. Thank you so much for joining us today for our webinar presenting our new investment opportunities. We're really excited to have you. Whilst we have a couple more people joining, I will play a short video. Welcome, everybody. Thank you so much for joining us this afternoon. My name is Laura Nieves, and I am proudly responsible for Astor Realty Capital's investor relations and operations. So we are super excited to have you today to discuss our newest investment opportunities. Our opportunities today are a 205-unit value-add multifamily investment opportunity in Dallas-Fort Worth, Texas, and also a cold storage redevelopment in Columbus, Ohio, but is an extremely in-demand asset class. So we are very excited to be presenting them to you. We will have the opportunities for questions and answers during the Zoom, so please feel free to drop your questions below in the chat, and Joe will do his best, to address them. And if they do not get addressed, we will we'll reach out to you after the Zoom. So today, as we are discussing a new market, we thought that we would take the opportunity just before introducing Joe, your host, to share a short video about some of the market highlights in Texas. We know obviously a lot of our investors are here on the East Coast, so we thought that we would take this opportunity.
They say everything's bigger in Texas. Welcoming more than 300,000 people last year alone, it's growing so much that the state has reclaimed the title of the #1 growth state in America. Texas is the second largest state in the US and the second most populous, holding 6 of the country's 20 largest cities, including Houston, Austin, Dallas, and San Antonio. Austin, known as a hotspot for commercial real estate investments, corporate relocations, specifically in the tech space. Texas reported a statewide employment high in November 2021, surpassing pre-pandemic employment. Austin has the hottest job market in the country. From Elon Musk relocating to Austin, he is expected to employ 5,000 workers at the new 2,100-acre facility. Facebook announced they will be leasing offices in Austin's tallest skyscraper to date, still under construction. Apple, Samsung, and Oracle are just a few of the other large businesses that have relocated. Texas's well-known oil and gas industry contributed $15.8 billion in the state economy and has directly supported more than 420,000 jobs. Texas's commercial real estate market has heated up like nowhere else in the country. Austin is ranked at one of the nation's top commercial real estate markets. Office occupancy has grown rather than shrunk in the past 12 months. Multifamily enjoys one of the most robust levels of construction activity in the country. Advertised rents in multifamily are up 21.2% year over year. Are you ready to invest in the Texas market? Stay tuned for Astor's upcoming investment opportunities.
So I hope that you enjoyed that video, and I hope that you guys are excited to invest in the Texas market. So just before we start and I introduce Joe Berko, I would like to say a couple of words about our firm. We do have many new investors here today, so thank you so much for joining us. We're excited to have you. Astor Realty Capital, we are a private equity firm, and we currently participate in over $1.7 billion of assets nationwide. We have assets in 11 major US states. We're headquartered in New York. We have operations in Miami and Phoenix, Arizona. And the Astor team, along with Joe and Michael, consists of experienced real estate professionals, and we are fully integrated with our sister company, Berko and Associates. So today hosting us is Joe Berko. Joe is the co-founder of Astor Realty Capital, and over the course of his 25-year career, he has structured, raised, syndicated, and sold over $3 billion. I believe actually that's $4 billion in commercial real estate. So on that note, I'm very excited to pass you over to Joe.
Thank you, Laura. Thank you for the nice introduction. Great to see everybody, our existing friends and family club, and some new faces as well. So welcome, everyone. Talking today about two properties. I'll do my best to kind of like keep it short and go through it. And of course, the information will be sent over to you. So any questions you might have, you might reach us, you might reach me afterwards. Where we can have specific discussions. So the first property that we're looking at is the Junction. It's in fact 205 units, blue collar workforce housing located in Arlington. Arlington is essentially somewhere right in the middle between Dallas and Fort Worth, sort of like 15-20 minutes away from major employment centers. Requiring this asset with a local partner for the total structure of $31.5 million, using $22.5 million of debt and $9 million of equity. Astor is going to hold a position of 47% of the asset. We have another institutional group that's taking a smaller amount, and of course, we always ask that our developing partners or sponsors, in this case, will have a substantial stake in the game, and so they're holding 20%. Essentially, we're looking to enter into an existing cash flowing complex that is occupied today to the tune of 96%. Rents are lower than average, lower than similar complexes in the immediate location by roughly about 15%, maybe a little bit more than 15%. Our objective here is to come in, to do some renovation, put some uplift the way the property looks. And by the way, it looks great, but it could use a little bit of a a little bit of a design element, a little bit of a changing of counters and so on. Nothing major to the apartments, but we are looking to turn around, I'd say about 55–60% of the units over the course of 2 years, then place the property on the market for sale and exit with a profit that we anticipate will be somewhere in the vicinity of 56.6% to you, the investor. And if you chop it over the course of 3 years, so you're looking at about 18.8% on an annualized basis. Why we like this property: generates over an 18% for the level of risk that we're looking at. We feel that this is an attractive return, short term, 36 months. Property as it is right now is highly occupied and generating cash flow. We're buying it for more of a 5% cap rate, not an easy thing to do. Certainly not in Texas, certainly not in the vicinity of Dallas and major hot locations. Arlington is a growing market. Rents have increased year over year by more than 9%. We've seen more severe increases in different markets. And we like our developing partner, our local partner. We always choose good partners to place capital with. And we always make sure that they're experienced and that they have a reputation, but certainly know what to do. As far as the business plan, I'm not going to go through the details. I'm sort of like creating the business plan as we go along. Again, you'll have this information. You take the time to go through it. The asset itself, as I said, blue collar. We're looking to do some upgrades, improve the way the property looks, both outside and inside. We have about $9,000 that we're looking to spend on the units that we will be making some of the changes into, some of the renovations. And again, some of the property condition outside will just simply upgrade, but it is in a great condition. It's been over $5–6 million that was placed into the property in the last, I think, 5 years or so by the previous owner. It's a fairly substantial company in itself. The due diligence phase is sort of like coming to a very close end. As I mentioned, we're going to be looking to turn around about 69 units in renovation year one. Renovation takes roughly in the vicinity of 2 weeks, and lease up takes roughly another week, maybe call it 2 weeks. We're taking into account and moving on. The second year, we're looking to renovate 64 units, and then sometime around the second year into the third year, we're looking to sell the property. Hi, Lloyd. Thank you for asking. How old is the property? It's 1970, which makes it about 52 years old. Just a couple of years older than me. But you went through a good amount of renovation over the years. We'll talk a little bit more about similar properties. We'll spend a number of days over there visiting a number of properties, and making sure we totally understand the market, we understand the competition. So again, as far as the capital stack is concerned, we're taking on $22.5 million of debt. Astor is coming in with about $4.2 million. The other LPs are coming in with just shy of $3 million, and the GP is about $1.8 million. We're going to be holding 47% of the equity in the asset and the ownership in the asset. The other institutional LP, which is a local Texas-based, Austin-based with offices in the West Coast as well, is taking in 33%. They have an existing relationship. It's not the first time that they've been doing business. I'm always happy to see the partners are coming back for more, and the developer or the sponsor himself is taking 20% of the asset. Our projected pro forma is right here. We're looking to stabilize at $1.29, and essentially the property going through expenses, going through the projected NOI, we're looking to stable at around $1.8 million. Again, I'm not going to go through the linear as it comes down to it, but we're taking the assumptions according to how the market standards about vacancy, cost of payroll, everything that has to do with some collection loss, some concessions which sometimes happen, bad debt. Sometimes not everybody pays on time, and some people just decide not to pay. all that good stuff collectively comes together. Essentially, we're looking to sell the property at roughly $37.7 million. And after taking out some sales costs, paying back the existing debt of $22.8 million, $22,790, paying back, of course, our equity, we're looking at around $7.948 million. And eventually we are going to distribute to our investors. I really apologize for helping with sliding of the presentation. Thank you. So in this example, we're essentially looking at a $50,000 investment as an example. We have a $2,500 participation fee by our investors on a 36-month turnaround. We're looking to a total projected return of $29,641,000 for a total of $79,641 or 56.5% return. I want to keep your focus on the right side, if I will. This is basically the breakdown of how the amount of money that we're raising at this point in time will be broken down. And I just want to make sure that we all understand kind of like the risk associated with market fluctuations. So on the right side, this little chart basically represents where the market is today. The upper portion represent what we believe is market condition today. At around 4.5 cap, plenty of evidence that the properties can sell for more than that. If that was the case, if we were to sell this property today after renovations and everything, essentially we would be expecting to make somewhere in the vicinity of 25%. However, we're taking into account that there's fluctuation in market conditions. We're taking into account some increase in interest rate, which will affect valuations. And with that in mind, we're sort of like expecting a little bit of a lower bang when we sell the property. So somewhere in the vicinity of a 5% cap rate. Mind you, it's not an easy thing to find properties, certainly not multifamily for a 5% cap rate, but we're looking into somewhat of a conservative approach. And so based on that, this is how we're achieving our potential return. Should market conditions get even softer than that, then we show additional examples. And so you can pretty much get the understanding that nothing here is an exact science. While we're doing this, we're taking a conservative approach. We're always basically taking the approach that things will either stay the same or get worse. And so we're anticipating some softening of the market, but you can get the idea here as we're stressing potential returns. A little bit about our local partner, American Ventures, led by Shravan Parsi. We are looking into a seasoned team that's been around the block for quite some time. They are located in Houston. Fantastic guys, experienced guys. They've done over 4,000 units of multifamily, pretty much the same class of apartments in Texas area alone. They don't operate outside of Texas. They have a niche to find those off-market deals. They buy well. They are seasoned in terms of turning around renovation fairly quickly. They've had previous experience with the Arlington market on two different complexes similar to this particular complex. So we feel very comfortable with their experience. We met out there. We've been talking to Shravan and his team for probably the past 7 years on multiple occasions. So it's sort of like a little bit of a lengthy relationship that we had with Shravan and his team out there. Conceptually, we've been looking into the Texas market for the last 2 years. What we found is basically it's an overheated market. A lot of capital is chasing those deals. We just decided that we're not going to drink the Kool-Aid. We're going to wait for the right property. And so it took a while for us to understand the market and multiple visits and multiple sites and a good amount of information collected. We feel comfortable with the right group to go after this property. This is some of their previous properties that they've owned and exited in the Texas market. They've turned around, as I mentioned, over 4,000 units and close to $200 million. Typically, they hold and turn around assets in a short duration, as you can see here on sales date and investment hold period, somewhere between 2 and 3 years, kind of like their strike price. with one exception, but pretty much a short turnaround. So we love short turnarounds. We love properties where we can come in, we can make the impact in a short period of time, get a hyper return, return the capital back to our investors, and repeat. Some of the existing assets that they hold right now, again, from Corpus Christi to Waco, San Antonio, and Dallas, Texas. And they are also in the process of selling those assets as well. Again, this period of time, it's easier to be a seller than to be a buyer. This particular example, we're showing you essentially where we are in this asset in terms of current rent. You can see the average at the lower portion. Our average rent per square feet is about $1.10, and we're expecting to, on average, increase rents by about $174. Depends on the various units, and achieve about $1.29. In a moment, we're going to take a look at some of the other complexes and why we feel that this business plan is highly attainable. So on the left side, right above with the little red star, this is Junction. This is the subject property. We're looking at 5 different complexes in the immediate location, very, very short area, very short drive, or even a walking distance away from the subject property itself. And so, we're looking at about, if I have you focus on the effective price, which is kind of like bottom line, you can see that we're somewhere at about $1.10 on our subject property, where similar properties, maybe a little bit newer, but similar properties are hovering around $1.52, $1.54. With some extension, we have $1.65 and $1.30. So I think that as far as the business plan is concerned, to achieve the $1.30 mark is highly attainable. We feel that to go above that might be considered a little bit too aggressive. However, there's a very good likelihood that we'll be able to do a little better than $1.30, and if so, we'll all make a little bit more. Some more properties for sale. Take a look at the cap rates. We're looking at a market that is, again, it's impossible to buy. The reason we have this property at a cap rate of about 5.14, so the acquisition is completely not a representation of the market. I feel we got a phenomenal deal. It's because it's an off-market deal, right? And an off-market deal, for to kind of like give some color to this sentence. There's 2 ways to sell a property. There's many ways to sell a property, but typically it looks like this. Either a seller of a complex will come to a broker, typically a nationally recognized broker, who's going to onboard the property, create an entire marketing plan, and send it out to thousands of individuals. Eventually achieve somewhere in the vicinity of 20 to 30 different offers, where there will be second round of bids and a third round of bids and best and final and so on. And so every last dollar will be squeezed out of this property to this really, really fantastic process, which is great if you're a seller. If you're a buyer, we're not happy with those processes. But put this aside, sometimes there's what we call the off-market deals. And so the off-market deals is typically a conversation between a seller and a broker, or between two buyers, and they strike a price without going through this lengthy process where all the information is available for the world. And so this is kind of like the case here. And so I think we were able to be lucky enough to enter into something that is fairly underpriced. And we feel that it's fairly underpriced because as we're coming closer and closer to the strike date, the closing date, there's enough kind of like noise around Arlington and around the area that we feel that folks will be willing to even pay a premium to buy the paper. In other words, to buy the contract. This information will be shared with you with information about the Dallas-Fort Worth. We're very highly excited about the Dallas market. It's a large area that is growing in population for the right reasons. Many corporations are coming in, and the flow of capital keeps on going into Texas, and so it's a very, very solid market, one of the strongest markets in the United States. We're very, very happy to be taking a part of this, and this is going to be our first entry into the area, and we're hoping to do a lot more. Let's move. Actually, before we do that, let me see. What are the rent increase guidelines, if any? This is not under guidelines at all. Those properties are not like in New York. So the question was, are those properties stabilized? If there's any form of stabilization or any form that will prevent rents from going up. So this is market, it's a free market property. Unlike places like New York and California and San Francisco and Boston, where you have to go through some sort of a guidelines on out-of-dated properties. Here we don't have these issues. The second asset that we have is going to be an asset located in Columbus, Ohio. Columbus, Ohio essentially is a cold storage property, and we're teaming up with an existing partner. With him, we've been building for the last 4 years a fantastic asset in Queens, New York, over 100 units, and we're happy to go into our next venture together. This particular group, Skyview Partners, and particularly Michael Dana, who's running Skyview Partner, is a very seasoned group and been doing business throughout the United States in multiple asset types, from the ground up construction of very large complexes of multifamily, retail, office, and industrial. This particular story here is the story about an industrial property, an existing 105,000 square feet that we're looking to acquire, renovate. A tenant is moving out after many years of being there, was paying very low rent, and we're going to release the property after it's renovated and achieve higher rents and hopefully put it back on the market and make nice return for us all. Essentially, the total budget for this project is $17.57 million. It's 105,000 square feet, rentable, existing cold storage facility. We'll talk more about the cold storage and why we're excited about cold storage. And we're hoping to achieve a valuation of around $22 million when we sell the property, based on what market conditions are in terms of cap rates and valuation and so on. Astor is going to be holding 80% position in the property. We're coming in with about $4 million. And we're hoping to achieve to our investors at a turn of a 2.5-year time span, 58.6% cash on cash, or 23.5% return on investment. Closing is anticipated to happen imminently in the second week of March. The story of cold storage is quite unique, but why we're excited about this property, it's because we're working with an existing seasoned partner, seasoned developer, seasoned operator that we have a good track record with. We're super excited to do a lot more business together. We are looking into a short-term period of time, 30 months, 23% a year, not too bad. Acquisition basis is considered to be in really good position. We're buying low, well below replacement cost. We're looking for something that has fairly low risk and a very nice low risk to adjusted return. We'll talk more about why cold storage, but essentially the business plan is fairly simple. This is a large refrigerator with 34-foot ceiling heights that is in tremendous demand. Where is the demand coming from? Essentially, we're talking about an industry that is exploding all over the world. The new consumer is less and less interested to buy their fruits and vegetables and perishable goods through their grocery. I love to pick my tomatoes and to pick the right bananas and the food that I buy. I love to see it, but it's becoming more and more of an emerging trend to simply ship perishable goods into your doorstep through Amazon and through all the other avenues. And so the cold storage industry, which truly only represent 1%, only 1% of the entire industrial gamut, right? Of all the logistical centers and everything else, the cold storage represents 1%. And it's an industry that is growing exponentially. According to Avison Young, which is a large leasing brokerage company, The $89 billion cold storage industry is projected to grow to about $218 billion by 2026. So it means a couple of things. It means that, first of all, there isn't enough supply. The demand is going through the roof and there isn't enough supply. As it is, we're already seeing tremendous issues in the industrial spectrum itself. If you look at a place like New Jersey, the vacancy factor over there for industrial in general is about 1.5%. When we looked at Columbus, Ohio, vacancy was effectively zero. There is no space. In fact, when we spoke to CBRE, the broker that we're bringing to do the lease up for this property, he told me that the pool of tenants is going to come from 3 different states. So in other words, we have a specific property of 105,000 square feet. And if this was retail, we would be very sensitive where we are exactly on the block, where we are, how far we are from certain different areas. Retail is super sensitive. When we look at comparables, we look at comparables in the sense of, how close you are to our subject site to consider you to be comparable. Here, because the demand is so through the roof and there's not enough supply, they are pulling tenants from 3 different states. And so it's quite a story right here. A lot more information available here in this presentation, a lot more information available for those who are interested in our deal and would like to see our data room with all the diligence material. And so in terms of acquisition, we're looking to close late March and then commence with an 11 months of construction into which we will start doing our marketing. What's unique about industrial spaces is that tenants wants to move from now to now. It's typically the right amount of time for a tenant to look for space is about 3 to 4 to 5 to 6 months. That we've been doing with our partners a lot of work on looking at proposal because we're looking to outfit this entire tremendous refrigerator, if you will, okay, with replacing all the material and bringing everything. So at the moment in time that we close, we want to push the button and immediately go. So we have multiple proposals coming from different contractors that are specialized in the cold storage segments. And so we're really gearing up and ready to go. So 11 months of turning around both construction, inside, outside, outfitting everything, leasing it up, holding it for a short period of time, and looking for an exit. In terms of senior loan, we're taking a loan that will be $5.9 million on acquisition date, with an additional $6.6 million immediately available for us through requisitions. In other words, as we go through the renovation of the asset, both outside and inside, we're going to draw down from the second part of the loan itself. Astor, as I mentioned, is bringing 80% of the capital. GP Equity is doing about $1 million or 20%. We will hold a majority stake. We're looking at about a budget of $17.56 million in total. Projected gross sellout at around $210 per square foot. We're hoping to generate about $22 million, and after sales expenses, we're looking to achieve around 4.693, of course, after we repay back our debt and pay back the equity invested. On a $50,000 investment, with again investor participation fee of about $2,500. That's the addition. 30-month time span. We're looking to generate 58.62% return to you, the investor, net of all fees, and around 23% return. Where we are in the little stress test that we're doing here. So we feel that the market is around the 5.5, 5.75 at hopefully the time of sale. Our brokers tend to be sometimes rosier. They feel that the market, depends on which tenant we're going to lend, will be somewhere between a 5 to 5.25. If this was the case, the annual return that we're showing here is the annual return to our investors. So I don't believe that this will be the case. I'd like to think so, but I don't put it into our performance. So we're looking into something a little bit more conservative. And if that is the case, again, markets will do what markets will do. We're looking into 23% annual return. A little bit about the partners themselves. So Skyview Companies, led by Michael Dana, has got a very, very seasoned team. Again, a pleasure to work with in the last couple of years, last 4 years, in fact. And we're about to exit from a very successful project located in Queens, New York, 100 units. Built it throughout the pandemic, almost no downtime at all. Leased it up well, better than we expected, and we're hoping to achieve better than our projected initially when we started the project 4 years ago. So Michael is sort of like Michael Dana is sort of like if you will, a bit of a mentor to Marty Kite, who's essentially been kind of like a family friend who lives in the West Coast. And he's actually the one who brought the property over to Michael's attention. They've analyzed it together. And so our two sponsors here are essentially is the group that's located between Skyview Companies and Yukon Properties. Yukon Properties is focused mainly on the industrial and the cold storage space. Skyview essentially is sort of like a developer, does very large projects. Those of you who are in Queens are familiar with this project. The retail portion of this was sold to Blackstone. But they've been doing a lot of great things. So you can take some time when you get the presentation and read about Michael, a fascinating guy, as well as Stephen Tellis. So we're happy to repartner and create another venture together. We focused on some of the assets that they've owned over the many years, Skyview Partners, over the very many years. We mainly focused on their experience in the industrial spectrum, in multiple states. They always have done really well, so we don't anticipate that this should be any different. Upper right is the project that we're building together with them, the urban, fantastic project, rental project, 100 units and a good amount of retail. And I'm happy to say that they truly did outperform. Yukon is the second partner, the more junior partner of the two, who's sort of like focused on bringing good deals, right? Just talking out to the brokers communities and to the sellers and property owners, and are the ones who are supplying deals to Skyview. And so the story goes. So they have some experience in the cold storage space. Wonderful guys, but with this type of experience, we will not be going into business. But the combined collective between Michael Dana's team and between Yukon, we feel very comfortable. So I mentioned before, if you're looking into Columbus, Ohio as a market for cold storage, and you wanted to come in and lease something today, the answer is there's nothing available. There's a couple that coming online that are being built right now from the ground up. It will take another 24 to 36 months for them to deliver the space. And the rents that for new storage facilities that is being asked right now is probably about 30% higher, 35% higher than the facility that we have. And so no availability, and when something is available, typically tend to be quite more expensive than what we're here to offer. We looked at this industry almost across the United States. Again, this is an anomaly. This is a very, very unique asset class within a unique asset class that is going through its own explosive type of tenants that are there, understanding the type of exit scenarios that we're seeing, and the information is available to you. Essentially, if you look at an average, we're looking at around $13 per square foot. Again, this is not new storage facilities. These are older storage facilities that might have went through some renovations. We're assuming that our rent is going to be below average. Why? Because we do. We always do. Even though our brokers are saying that we're being conservative, I like to surprise ourselves in a positive way, and so we're taking the stand that we'll probably do about $1 per square foot less than what the average is. And really, with all factors considered, you really don't have to be a big real estate guy to understand that when you have such a tremendous demand, you'll probably be able to dictate how rents are going to go. Um, in terms of exit sales, we're looking into somewhere in the vicinity. I expect cap rates to compress. In any event, we're looking to about 9 to 10% lower than the average all around in terms of dollars per square foot. We're at 210, where it's about 230 per square, $230 per square foot, 224 being the median. A little bit about ourselves. I'll spend a couple of moments here because we have a lot of new faces and new individuals that are joining us. So Astor Realty Capital is a private equity. We're institutionally backed private equity firm. We're relying on the experience of two principals, which is myself and Michael Corain, which is my partner, who's here as well on the Zoom, observing this time. And, we've been together working for the last 12 years, I would say, but each and every one of us brings together experience. My experience about 26, 27 years, Michael's about 36, 37 years, 35 years. So we're over 60 years of experience. What's unique about us, or what keeps us focused on, is first and foremost, preservation of capital. The story of Astor is essentially being able to offer our friends, our family, folks that are working and saving, the ability to step in and with considerably small money participate in what we call institutional size and institutional quality type of properties. And so, so that's the first thing, preservation of capital. If we don't know how to exit a deal, or we don't feel that it's not a safe deal, if we don't have a plan B for market condition shifting, then we simply don't enter the deal. Ongoing asset management, we have a dedicated team. We essentially, as opposed to giving money to an operator, a local, as sort of like someone to watch, as they are managing the day-to-day, we manage the month-to-month, make sure that money goes in the right way, make sure that everything is on time and on budget. Our own capital is invested alongside into that vehicle. We take the exact same risk, just like any one of you. Today we're doing above market returns. In fact, as of this afternoon, we're doing about 24% on average on our equity deals. 24% on average on our equity deals. We have three segments of deals and transactions that we do. The first segment is just like we're looking here, which is called the equity segment. We essentially form together a partnership. Each and every one of our investors collectively own a proportionate share of the property. So you're an owner of the property together according to the shares that you bought into this asset. That's an equity transaction. We also have two other lines of business. The other one is called the preferred, where we can create segments between capital that's invested in the deal by the sponsors, but maybe additional investors outside of our of ourselves, and we have a priority of return of capital. And the third one is investments in loans, either a first position loan or a mezzanine. But our returns seems to be so far so good, really above average. Alignment of interest, as I said before, our capital is taking the exact same risk as everybody else's capital. Doesn't have any other than the fact that we manage or we're on the day-to-day, but we are subjected to the exact same elements as everyone else. And the personal approach. The majority of our capital, as I mentioned, is coming from an institutional group. So we're managing one very large partnership. It's been going on for this is important to us to understand who you are, what your objective is, what sort of risk level you're willing to accept and to take on. And you have access to us, you have access to myself and to Michael and to Laura and to the rest of the team. You have your own portal. And so this part is absolutely sacred to us, and we'll keep it that way. More information about ourselves you can find here, short resumes. But again, you should talk to your friends. You should do a Google search. There's plenty of information about us, both on articles and things that were written and awards that were won and so on and so forth. So I'll spare you those details, but if you're interested, take the time and do a little bit of a review. A little bit about our properties, our other properties. We have at the moment about 3.5 million square feet and in 7 different states that we're investing in 11 submarkets. And our portfolio spends at around $1.7+ billion at this point, from New York to New Jersey, Florida, Chicago. Right now we're entering into Texas, Columbus, Ohio, and other locations as well. We're keeping a very, very high interest level. And to Phoenix, Arizona, we have 3 different offices spread out geographically between New York, which is our headquarters, New York City, Miami, which is myself and a group of individuals are located and operating out of, and Michael and his team are operating out of Phoenix, Arizona. It's a very steady team. We've been working together for many years, and right now I think I'm happy to say that we're entering new markets, but it takes us time, right? It takes us time to learn, to feel comfortable, to visit. Okay, very great. Will companies that use cold storage, this is a question by Mark Sirota, will companies that use cold storage generally want an existing generic facility as opposed to their own custom-built facility? Great question. So the answer to that is, when you, let me say it differently. My mom always said beggars can be choosers, right? When you have such a limited supply and you need it, then that's what you take. When you have the luxury, for example, we were invited into an industrial storage facility that was supposed to be built for suit, and that was built for suit for Amazon. So over there, Amazon sat down, they have an existing spec, an existing plan, and they tell you exactly how to build and how wide is the entrance and how do you turn around and all that good stuff. So that's one segment. In other places, you have less of that flexibility. The cold storage facility, for example, would probably lend itself to more than just one tenant. And so what we do at this point is essentially offer the facilities and accommodate tenants with the ability to do some custom build, but with some with a lot of with some flexibility, but it's not like we're building to suit, right? So it's not as specific to that. Again, we're relying very, very heavily on the fact that the supply is close to non-existent. Let me see if there's any other questions.
Joe, this is Michael. If I can just add one other point to what you just raised. And Mark, typically, there's a very high barrier to entry in this market. The cost of building this type of facility roughly is about somewhere between $150 to $350 per square foot. So for anybody to want to build their own custom facility, they'd have to build a lot of, there's a lot of equipment involved with refrigeration and other stuff that they need to bring in. And it does not become very cost effective to do it for their own rather than having one facility cater to multiple customers. And in this case, in both situations, for a company to try to develop it for themselves or for a developer looking to build an entirely new facility, it's a much more compelling proposition to be able to work with an existing facility. And in this case, it's an existing facility that is going to be upgraded to state of the art. And, it takes away the cost from a lot of these companies. So it does become cost prohibitive for a lot of companies to try to do it for themselves.
Irv Brown, how are you, Irv? The question is, does the ROI consider the $2,500 fee or only the initial $50? Yes, it does. Our structure is, while we ask our investors to participate to what we call keep the lights on, pay the salaries and so on. So the 5% participation fee, when we're doing the ROI calculations and we're saying it's 23.4%, I think the number was, it's taken into account that It's your investment, initial investments, plus your 5% participation fee. And we look at this entire collective check when we're doing our analysis. I do want to give one small point it's not a large raise. I'm not sure. In fact, if I may say it differently, I'm expecting to be pretty full on this. We're expecting to be pretty full on this investment momentarily, if not already. It is important for me that you are aware of this asset class, and I think it's important because we're looking to transact a good amount. In fact, we've sort of like made an internal decision that while we're highly focused on certain geographic location where we want to have footings and hold and grow in those areas and create economy of scale, as it comes down to the cold storage facility, particularly, we're going to be a lot more relaxed as it comes down to geographical location. Not relaxed as you come down to partners. That's why we're not going to get relaxed at all, right? We always want to have the best possible partner. That's not something we're flexible about. But in terms of cold storage, the demand is so severe. Looking into the next 4 or 5 years, 6 years, maybe even longer, that we want to be in as many cold storage facilities as possible. So even if you're interested and you didn't get to have participation in this one particular deal, it's important for me that we go through this educational process so you feel comfortable. Because I think we're looking into something that's going through an exponential growth. So thank you very much, everyone. If you have any questions, feel free to reach Laura, to reach Michael, to reach myself, or any member of the team. I'd love to talk to you about Texas, the multifamily segment, which is a nice, solid deal, and of course about the cold storage facility and everything else that we're doing. There's a lot of good individuals that are joining us today. So anything else that we're doing, you'd like to learn more about, we're here to have a conversation. We can have a private conversation and try to answer your questions. Thank you very much. And thank you, Laura. Thank you, Michael. And thank you all for joining this afternoon. I'm looking forward to continuing our conversation and to continue investing together. Take care.